Now let's take a look at some of the key factors that impact the economy of the United States. Now, one way to look at our economy is all of these variable features that actually impact each other. So if we look over here on the left-hand side of your screen, you see government policy and the certainty around that. And by the way, that directly impacts the cost of money. So the interest rates that are being charged and what it costs to borrow money. Now, the GDP, or the gross domestic product, actually are impacted by tariffs. Now, the challenge that we have in the world that we live in today, all of these things will impact inflation and unemployment. Now, in a market, typically what we see is when inflation goes up, unemployment goes down. When unemployment goes up, inflation goes down. And you're going to see here in a moment that we're in a very unique time where we're seeing both unemployment going up, as is inflation. Now, the challenge with that is that now the Fed has to pick their poison. And what I mean by that is they have to pick what they are going to focus on, whether it be, are we going to try and improve unemployment, right? So put more people to work, or are we going to stay focused on inflation? Now, by the way they deal with those two problems are exactly the opposite. So, for example, if they want to improve unemployment, they're actually going to lower interest rates so that businesses borrow more money and look to expand, and consequently they hire more people. If, on the other hand, they're looking to combat inflation, then the idea is they raise interest rates, which slow down spending, which then lowers the inflation rate.